She said thanks for thinking she's cute. And she's from CMU, by the way, so she
Oh,
said
I
good.
won't hold that against her. She's a Republican then.
Um, she said that her mom's a U of M alum, and she
Well,
says
there's nothing wrong with that either. All right, she's back on the good graces. That's fine. All right, everybody, good evening. Welcome to week 2 of our fall experience of business finance. Here's what we're going to be doing tonight. Getting acquainted to what accounting provides us for finance. Getting reacquainted for some of us with the financial statements of a company, what they tell us, the balance sheet, the income statement, the statement of cash flows. No, you don't have to worry about putting these suckers together, but you do have to know what they tell you because they tell us what to do next in our business. Are we making enough profit? Do we have too much debt? Do we have a substantial portion, a problem with liquidity, not much cash flow? The financial statements give the finance manager a good perspective of where they go to next. Hey, we have too much debt. We can't borrow any money. What do we do next? Do we find a partner for a particular project? Do we issue stock? Do we look for government investment? Stay away from that. But whatever, what do we do next? And the financials tell us that. So we have to understand what the financials tell us. That's chapter 3. Also, what do we use? What information can we get from the financials that tell us about trends in our business? Quarter to quarter, year to year. What do financial information tell us about our competitors? Remember, if you're a publicly traded corporation, you have to, by law, announce or show all your financials to the world so you can see what's going on with your competition. Also, what is going on within our industry. All right. That's what chapter 4 is about. A summary or a measure of corporate performance, how to take the financial information, the balance sheet, the income statement, and the statement of cash flow, and what does it tell us about liquidity, profitability, leverage or debt position, efficiency, our relationship in the market. That's chapter 4. And once we have all these basics of 1, 2, 3, and 4, then we're ready for a little assignment next week. But we still have some work to do before we get to that point. So that's where we're headed for this evening. But I wanted to make sure that you're all aware of is that we do have some discussion posts that were due. And I wanted to make sure that we're all familiar with that. Those discussion posts were due yesterday, Sunday, a bio and a portfolio. Now, many of you posted your portfolio, but I also sent it back for resubmission for a variety of reasons. So make sure you check your discussion forum for any replies by me. And the secret to that is if you have yet to see a grade posted for your discussion forum for week 1, either A, you have not posted anything yet, or B, I'm waiting to hear a response for something that you need still to be done. So if you could take a look at that after class and clean it up, I'd appreciate it because then you can get your grade for the first week. And many of you was in the portfolios. Remember, the portfolio was to be in a spreadsheet format, not a PDF format. So some of you need to resubmit that. Also, some of you had the incorrect data for the 3 market indexes, the Dow, the S&P 500, and the NASDAQ. I'll ask you to clean those up and resubmit it. So you might see a grade for a 90 in your work, but if you resubmit those corrections, I'll give you 100. All right. So just make sure you clean some of that up. Also, we have another piece tonight, which begins tomorrow. Wednesday and Thursday, this is Professor Meeting Week. where I would like all of you to pick a time on Tuesday, Wednesday, or Thursday, post it to this discussion forum, then I'll list it here, and click on this link at your allotted time, and we will talk one-on-one about the first couple weeks of the course. So Mr. Connor is on for the very first tomorrow at 11 o'clock. And then subsequently through Thursday evening. If you have not done this, please do so this evening. This is also for a grade, an easy grade. All you have to do is sign up and attend. You get 100. This is just for you and I to sit down and talk about if you have any personal concerns about the way the course is set up. Because I'm from Michigan, you don't like me. It's good to know. Or anything else about our course or questions you have, this is a good time to do this. So we have times available Tuesday, Wednesday, and Thursday. Now, if your schedule does not allow you to any of those times, send me an email, Mr. Hassey, I can't meet Tuesday, Wednesday, or Thursday. Then we'll set up a time for the coming weekend, according to your schedule, when we could have that little chat. But this is important stuff, especially in the online environment. I don't want for you to hide in the darkness of the internet when I never see you and never hear from you. The only times I hear from you is when you post something or do an assignment or some work. I need to see whether you're doing okay. Feedback. Because I assure you, if you and I are communicating pretty good, you'll get more out of the course. All right. So make sure, don't do it now, I'm talking, but make sure sometime this evening you sign up for a time to chat with me this week. It's for a grade. If you blow me off, you get a 0. So that's the second work we're doing this week, student-professor meetings. So make sure you take care of that this week. All right? Have any questions on that, just let me know. So that's our work that we have to do. That's the graded work this week. You have a graded work for last week. Most of you have already accomplished that. And you have graded work for this week to come and meet with me individually via Zoom, via this link during the course of the next few days. Okay, there we go. Again, here's our week 2 file folder. This week's is called Financial Statements, or better known as What Happened. There's my introduction video that I posted yesterday. This is a spreadsheet that I'd like you to download to your desktop that we're going to look at this evening under in-class review. And then here's a basic definition of financial statements and analysis. Our fact tonight is the Dow Index. What is the Dow Jones Industrial Index, which is part of your portfolio? Speaking of the portfolio, I was very impressed with some of your stock selections. Holy moly. Maybe I might fire my investment manager and hire one of you guys. I was very impressed by some of the stock selections. And then we get into a week review of all the chapters. This week we're covering chapters 3 and 4. There's a little review of what the chapters are telling us. PowerPoints from each chapter, a couple of videos. We'll be looking at this video later on this evening. It's only 3 minutes, but big deal. And chapter 4 and the PowerPoint. So there's all information, videos. These videos are also in our YouTube playlist, but videos to help you take the material of our topics this evening. So before I get rolling tonight, and the Yankees are beating Tampa Bay, which is always a good sign of things to come. Does anybody have any questions or concerns before I get into it this evening?
Professor, would it be appropriate to ask which stocks you were impressed by?
No, it wouldn't be appropriate. I will not say. I will tell you privately but I won't tell you in front of the group. I'll tell you in
Got it.
front of the group at the end of the class when we see how well you did. Okay, Alan?
Sounds good. Thank you.
Good. Good question, though. Thank you. How you doing, Alan? All right?
Good. How are you? I'm doing
Good.
all right.
Did you make an appointment with me for this week yet?
I did. Yes.
Very good. Okay, thanks. All right, see you later. Have dinner. Any other questions? Doreen Connor, where is that picture located?
I took that picture in Maui
Very nice.
7 years ago.
It looked like that was before you started drinking your Mai Tais. It's nice, and that's a nice picture.
Thank you.
Very nice. Okay, so let's get going. The old whiteboard, just like we were sitting in class in Burbank. Okay, last week, remember, we began our discussions, our preliminary PowerPoint by what is the definition of finance, maximizing shareholder value, looking at the relationship of a company to get capital, cash, excuse me, in relationship to the financial markets where you go out and get this capital from investors who are looking for return on their investments. And the financial manager or the CFO or the financial analyst is an individual in a company that's usually a corporation, because that's where the maximization of profits and capital can be made due to the diversity and liquidity of the capital in that company, and also due to the unlimited liability of the risk associated with a corporation. That compared with a proprietorship, a partnership, where there is, excuse me, in a corporation, there's limited liability, where in a partnership or sole proprietorship, there's unlimited liability, which creates greater risk. So that's one of the discussions that we made, or it's talking about that last night. And that all leads into where are we as a company. Now, when I do notes on a board like this, I save it and I post it to the in-class review file folder in Blackboard. So if you want to take notes, that's fine, but I also save these and I post them to our Blackboard after class, so you can see them, and there's your notes. They're right in your Blackboard. So if you want to take notes, that's fine, but I give you these posted into our Blackboard. Where are we as a company? And more importantly for us in this class, where are we going? That's one of the key questions about tonight's class. Where are we as a company? That's the financial statements. That's what the accountants provide us. Debit, credit, trial balance, adjusting entries. Ugh. Shivers my spine just thinking about it. But once we have all that financial data, we as internal users or management, and also as external users like our investors, our bankers, our customers, they know where we are. Are we making a profit? What's our balance sheet look like? How much is the company worth? What does it tell us about our business? And once we know that, where we are, then where are we going? Are we lagging behind in our industry? Are we the leader in the industry? Do we set the standards of our leaders, and our competitors are always trying to catch up to us, or are we always trying to catch up to them? That makes a big deal. When they're trying to catch up to us, they're spending a lot of capital to do that. We already got it. But if we're trying to catch up to our competitors, imagine being a competitor with Amazon now. Just ask the United States Postal Service about that one. Just ask UPS and Federal Express about that one. They have to spend a lot of capital to compete with them just on an even basis. So where are we going is driven by where we are today, right? I'm sure a lot of you, if you won the lottery about a year ago and won $10 million, a lot of you probably wouldn't be taking this class this fall. Why? You got your money already. You can skate. Now, if you're really into it and learning and want to know how to manage your money, this is a great class. But one of the reasons why you are in this class is you're preparing for where you are going in the future in your career, in the market, in your industry, in your company. That's why you're here. Well, that's our main subject of tonight is, where are we and do we understand where we are? And then in the next few weeks or for the balance of the course, where are we going to next? Are we going to invest in new markets? Are we going to just become more efficient within our own markets? Buy technology to become more efficient, in other words, saving costs? Or because of the pandemic and because of our industry, we're just trying to hang on to survive. A great example of that is what Disney did in the last week. They laid off 28,000 people. Now, Disney isn't going to go broke, but one of the reasons why they're trained in graduate school and business school is you have to prepare for where you're going, basically on what you have today. Disney cannot open up their theme parks because of the pandemic. So they can't spend the money to manage those theme parks, or they will lose money and their future is a little clouded. Who wants to own Disney stock when they're not making any cash flow or profit? So what do? They lay off 28,000 people to maintain their profit margins from ESPN and the Disney Channel. But they're saving on expenses by sacrificing, and that's a bad choice of words, by laying off many of their employees. And in Southern California, that's a big deal. In Central Florida, that's a big deal. They provide a lot of jobs for those communities. So Disney is doing exactly, they know where they are today. Because of the pandemic, they have to look out where they're going, so they lay off people. The same thing with the University of La Verne. Why are we not sitting in Ventura or Vandenberg or Burbank tonight or Irvine? It's because the government tells us we're breaking the law if we have classes with more than 10 people in a class. La Verne has to make a sacrifice because of that, because, geez, how are we going to make the revenue and provide the education if we can't have them in our classrooms? We go remote. But then we have to become more efficient in the use of technology. That's my job. If I'm not efficient, I'm not going to teach this class again. So as you can see, this is a very integral part of where we are as understanding the basic of business finance, is we have to understand before we can go forward or do any strategic planning, we got to know where we are today. In our textbook on page 27, there's a perfect question about that. At the top of page 27, and you don't have to look it up if you don't want to, but here's the question. It's question number 3 on page 27 at the end of chapter 1 in your textbook. What is the difference between capital budgeting decisions and capital structure decisions? Capital budgeting, I can't see anything. I gotta turn on some lights here, excuse me. There we go. Capital budgeting versus capital structure. Decisions. What does that mean? Well, those are the key main areas of financial management, business finance. Capital budgeting, capital structure. Capital budgeting is, where are we going to invest? That's capital budgeting. What are we going to invest in? And capital structure is how are we going to finance that investment. The CFO, that's one of their main jobs in a corporation or any company. Where are we now as a company? Okay, our accountants give us our financial statements. What do we have? What are we doing? Where are we going? Well, where are we going? There's two decisions. If we're going to go someplace, is it going to require an investment into new assets or existing assets? And if that investment does occur, how are we going to pay for it? That's what business finance is all about. Finding the right investment to give you an adequate return and profit and finance it for the cheapest amount of money. All right? Sounds like buying a house. Buying a house. When you buy a house, usually it's a struggle to make those payments in the early years. But if you can make those payments and have enough income to generate the cash flow needed to maintain that asset, the investment proves worthwhile because over time that investment grows, gives you a return. But how you finance it is the hardest thing, especially in Southern California. And a lot of you know this. How do you afford to buy a house in Southern California? The financing is the main deal. Well, it's exactly the same thing for corporations. What is one of the big competitors of Apple Computer? Well, it's Google, Android. Apple has a market share. Google has a market share of cellular technology. How do they compete? Apple comes out with a new iPhone 12 or 13 or whatever it calls. Contrary, Google comes out with a new Android device with more apps, a better camera. All those decisions within Apple and Google are to keep up with their market and their competition to provide a return to their investors. But that competition necessitates investment in new assets to create that return and how you finance it. Fortunately, Apple and Google are so rich with so much cash flow, financing is relatively easy. But what if you have a small business in San Dimas and you're trying to compete with Walmart or Target? Tough, because they have more capital than you have. Their financing to get new markets is really easy. Yours is taking everything. Difficult. So one of the key things that we come out of chapter 1 is what are the main focuses on where we are going? It's investment in assets and how we finance it. Capital budgeting versus capital structure. And last week we talked about the different types of businesses. Well, let's look farther down on page 27 to question number 6. What type of business are these? Different businesses that can operate investments and capitalization, providing services and products. Choose each of the following. What type are they? A business is owned by a small group of investors. A business is owned by a small group of investors. Here's a hint. Shark Tank. That's a private corporation. If it would say a business is owned by the market, by the public, that's a public corporation. You can still do business as a private corporation. Your access to capital is limited. That's why you go on Shark Tank. The business does not pay income tax. The business does not pay income tax. Well, that's an interesting one. I thought everybody pays income tax. Private corporation or partnership. Anyone want to give a whirl at that one? Anyone want to shout out and say, a business does not pay income tax? What type of company is it? Private or a partnership? This is kind of a technical question, so don't be upset if you can't get it.
A partnership?
A partnership? Exactly right. A partnership does pay tax, but the tax is based on the partner's share of the business, but the business does not pay an income tax. The partners pay the tax individually. So that's kind of a nitpicky question, but it's true. A partnership, the partners pay tax on their share of the business, whereas the company doesn't pay any tax. Kind of weird. The business has limited liability. Sole proprietorship or public corporation? Well, that's an easy one. It's a public corporation. Limited liability. In other words, they're only liable for the assets of the company. The ownership is not liable for mistakes, screw-ups, trouble. Whereas in a sole proprietorship, it's unlimited liability. We just talked about that a few minutes ago. The business is owned by shareholders, public corporation. Now, with the current tax law, you could probably argue for a partnership on this because it could be an LLP, a limited liability partnership. That's a partnership, but it's treated tax-wise as a corporation. So there is some discussion points there from when this textbook was written. The tax law has changed, but technically it would be a public corporation that's owned by shareholders. So those are just some definitions about finance, about what we are doing in finance. We're taking accounting data and determining where we are going by investing in capital and financing that investment. But what type of business we are determines that financing. A sole proprietorship, one owner, a partnership, multiple owners, and a corporation. Could either be a private or public ownership of shareholders in that venture. The type of entity or business entity it is will drive how you can finance and acquire capital for your business. And where do you get that capital? It's highlighted, and we talked about this a little bit last week. On page 53 at the end of chapter 2, the financial markets. The financial markets. What is a financial market? A place where you go get financing, capital. But also a financial market is a place to get public relations. The world can hear about your company through the financial markets, how you're doing. On the top of page 53, they list following, and they ask you which of these are considered financial markets and what are not. NASDAQ. Well, you already know about that one from your portfolio. That's a financial market. It's called the over-the-counter exchange. The Vanguard Explorer Fund. Well, the Vanguard Explorer Fund, some of you might have some of your 401k money invested in the Vanguard Explorer Fund. That's not a financial market, that's a financial investment. It's a mutual fund run by the corporation called Vanguard, which manages trillions of dollars of 401k and pension plans. JP Morgan Chase. That is a financial institution, a bank, the largest bank in the world. That is not a financial market. Now, you can go to JP Morgan Chase and get a credit card and borrow money for a mortgage and get investment banking services. But they do not set the prices, and you don't go to JP Morgan as a market source. It's a financial institution, the largest financial institution in the world. It's run by a gentleman who's run that company for the last 20 years, Jamie Dimon. He's a fairly interesting dude. And then finally on that list at the top of page 53, the Chicago Mercantile Exchange. That's a financial market as well, like NASDAQ. The Chicago Mercantile Exchange is where you go buy commodities, gold, silver, soybeans. It's a place to buy financial commodities, options trading. Chicago Mercantile Exchange. That is a financial market. I might have already told you guys this, but you know who founded the Chicago Mercantile Exchange? Joseph Kennedy, the father of our 39th President of the United States, John Kennedy, the father of Robert Kennedy, the father of Ted Kennedy. Joseph Kennedy founded, and the Kennedy family still owns a piece of the Chicago Mercantile Exchange. And matter of fact, a little bit other tidbits, if any of you watch the local news or follow the national news, there's a young lady named Maria Shriver. She's a granddaughter of Joseph Kennedy, and her father ran the Mercantile Exchange for the Kennedy family when he was alive. His name was Sergeant Shriver. Boy, I'm on a roll tonight. Okay. And that leaves us to this. Where are we now? This is that spreadsheet in week number 2 in our in-week review in class spreadsheet. It's the financial statement for a company locally here in the Pomona, Claremont area. This is an actual company. I happen to know the owner. He told me I could use this in my finance class. As long as I don't tell anybody what the name of the company is and what they do, I can use it. And I'm using it to show us where we are as a company. The financial statements. Many of you had to take accounting or got waived out of accounting to take this class. The accountants put these things together. A balance sheet, a statement of what you own, assets, what you owe, liabilities, and what you own of those assets, equity. The income statement, a statement of revenue and expense, profits. Profits which are distributed in the form of dividends to our investors, to our stock owners. And the third main statement of these financials is the cash flow statement, a statement of operations, financing, and investing on where cash comes in and out of the business, determining our net cash flow for the year. For our purposes in this class, this is numero uno. This is the one. Because it tells about our efficiency and profitability in operating our business. It tells us how we're either paying for or acquiring finances. And it tells us where we're investing our money. The cash flow statement. Notice for this company here on this statement, the cash flow for 2019 was $6,718. The net effect of operating, financing, and investing. Well, if I go to the balance sheet of this company, that's the difference between the cash balance between the 2 years, $6,718. The cash flow statement tells us where that came from. And that's very important for the financial managers of a company because they want to know, are we operating our business at a profit and cash flow? How are we acquiring the money to run the company, and where are we investing the money? to generate future growth and cash flow. Where we are going is perfectly highlighted by this cash flow statement. Again, you do not have to worry about putting these suckers together. But I have to admit, in assignment number 1, you're going to have a question that asks you to know what these 3 statements do and what do they tell you. The balance sheet, the income statement, and the cash flow statement. The result of the accounting transactions for this period of time for a company. So this is what chapter 3 is all about. Chapter 4 is all about taking this information and determining various different relationships in those numbers. Liquidity, debt management or leverage, profitability, market value, current ratio, debt ratio. We're going to need to have to know how to do all these transactions and what they tell us about a company. Page 105 of your textbook is the reference to this material. So our job for primarily the balance of the evening is to make sure we understand what these suckers tell you. Not so much, oh, the balance sheet's in balance. $3,516,952 of assets, $3,516,952 in liabilities and equity. Okay, cool. But what does that mean? How much of the company is in current assets? How much of the company is in long-term or fixed assets? How much of the company has current debt obligations due within the next year? What are the long-term debt positions of a company? Usually the interest-bearing debt. What's the stock par value stock position of the company? And how much have we retained in earnings cumulative over the life of this entity? And all these numbers are fueled by operating revenues and expenses during the course of a fiscal year. Remember, the income statement is for a period of time. The balance sheet is for a particular date in time. And in that regard, we're going to see a quick little video that highlights this. For some of you, this is going to be boring, but it's only 3 minutes, so bear with me. So here we go. Gotta find it first. Here we go. Leonard, you're my eyes and ears. Can you see on your screen financial statements? Okay, well, here we go.
We are going to discuss 3 common financial statements: the income statement, the balance sheet, and the cash flow statement. Are you familiar with these documents and why they matter to you? If you own your own business or even run a division of a business, it is imperative that you understand these statements because they tell you about the general financial health of the company. Also, if you have ever invested or considered investing in a company, whether through the purchase of stock or through a loan, you'll want to understand the company's financial health. In this program, we will explain each of these 3 statements and what their purpose is, how to read them, and how they can be applied in a real-world setting. So why is it important to understand all 3 financial statements? Basically, each one tells only part of the story. They are somewhat like pieces of a puzzle, and you need all three pieces to see the big picture. Let's begin by reviewing the general purpose of each financial statement and what distinguishes one statement from another. Simply put, the income statement tells you whether or not the company is profitable during a given period, usually monthly, quarterly, or annually. It may be helpful to think of an income statement in terms of a video camera. At the start of a period being measured, you hit the record button and the camera starts recording everything that takes place until you press stop. Similarly, an income statement indicates how a company is performing over an extended period of time. Knowing whether your company was profitable over a period of time does not necessarily tell you how much money the company has right now. That's what the balance sheet is for. In contrast to the income statement that records transactions in time like a video camera, the balance sheet is like a still camera, showing the company's financial state at a given moment. It provides a snapshot in time that can be used to determine how much the company currently has, how much it owes, and what is left for the owners. The cash flow statement is based on numbers from your income statement and balance sheet, and is like looking at your own checking account. It shows you what the company did to generate cash and how it used cash during a given period of time, often monthly, quarterly, or annually, like the income statement. Thus it answers two questions. Where is my cash coming from, and where is my cash going? Remember, while each statement has a different purpose, all three are necessary in helping us understand a company's complete financial story. For example, if you want to know whether or not a company is profitable, the income statement is what you need. Even though you know the company is profitable, if you want to know how much money the company has available right now that you can spend, you want to look at the balance sheet. And regardless of profitability and current available cash, if you want to know where cash came from and where it went, you look at the cash flow statement. Each document fills in a piece of the puzzle to complete your understanding.
Pretty simple, but that's okay. We want to keep it simple. And this is what the financial statements of a company tell us, this data. So let's go back to the statement that's been provided by a friend of mine. Notice, let's take a look at the income statement. For the year ended 2018, they lost $95,000. For the year ended 2019, they made a profit of $253,584. So that's a good thing. They went from a loss in 2018 to a profit in 2019. I always like to see that. But let's take a look at the internal numbers of this income statement, what it tells us. This number here is very interesting. It's called the earnings before interest and taxes. EBIT, earnings before interest and taxes. There's another name for that. It's called operating profit. That's the profit, hopefully it's a profit, on just the operations of the company. Sales of their products and services, expenses of managing those products and services, in this case, cost of goods sold, other expenses, and depreciation. Why do we keep depreciation separate in this financial statement? Why? Because it's a non-cash expense. And that's going to be important to us as financial managers. You're allowed by the tax law to expense depreciation of your fixed assets. But it is not writing a check to Mr. or Mrs. Depreciation. Whereas you're writing a check for these expenses and these expenses, you're not paying out any cash here, but you're allowed to treat it as an expense. Thank you, Internal Revenue Service. If you take the revenues or the sales less all the expenses, that's what is called the operating profit. So you can see in 2018, even though their net was a net loss in the operations, they still made a little profit. Because we want to keep separate operations from non-operating expenses, like interest on debt. $176,000 in 2018. Oof. And taxes. This company's tax rate is 40% of profits. Now, naturally, in 2018, they had a net loss earnings before taxes, so they got a refund back. 40% of this is added back in, so that's why they only lost 95,000 instead of 158,000, because they got a refund. But in 2019, when their operating profits were were a little bit over $500,000, notice their interest expense dramatically lower from the prior year. They must have paid off some debt. And thus they had a profit. They paid 40% of that profit, and thus there's their net income. So a couple things here of interest that we're going to need to know. What do I mean by operating profit? How is it different from net income? And also, keeping interest and taxes. The operating profits of this company serve its primary purpose as a company, providing goods and services to their customers. Interest is paying off debt to investors, probably bankers. And taxes is paying off to another group of investors, the United States government. You have to pay your fair share of taxes on the services the government provides you to do business in your particular area of the country. But as far as operations are concerned, you want to keep those and know what those are separate. It's important. Now here's another interesting tidbit from this information. Notice in 2018, they lost $95,000, but they still paid 11 cents a share in dividends. So meaning at the end of 2018, they had 100,000 shares of stock outstanding, of which at the end of the year, they paid 11 cents a share. So 11 cents times 100,000 shares of stock means they paid out $11,000 in dividends in 2018. Now, my question to this distinguished group of financial managers, why in the hell would a company that loses money pay dividends to their shareholders? That means they're going to have to probably go out and borrow money to pay dividends. Anybody have an idea why a company would pay a dividend when they lose money?
I would say that they
Profits.
do it.
Mr. Chandler, you broke up. Say that again, please.
I was gonna say, they probably still pay their dividends because they don't want to lose those investors, and if they don't pay out those dividends, then they could lose them. It keeps them in
Michael,
it.
exactly right. You are the man. Exactly right.
Sweet.
They want to keep their shareholders happy because they're the owners of the company. And remember, the management of this company works for the shareholders. If the shareholders aren't happy, and they probably still aren't happy because they lost money, they could fire you. They could fire the management team. Also, we might be wanting to raise stock again in the future. And so we have to go to the financial markets and say, hey, dudes, we need some more money. How would you like to buy some more of our stock? Why would I buy your stock when you're losing money and not paying a dividend? I might consider it if you're paying out at least some dividends every year. So Michael is exactly right. Not only is it financially respectable to pay a dividend, but also it's a public relations. You're telling the markets, stick with us. We're eventually going to make profits, and we'll still give you a piece of the return even though we lost money. It's a stretch, but it works. So Michael was right on the button on that one. Very good. But notice in 2019, they made $253,000 profit, and now look at, they doubled their dividend to 22 cents a share. But also, if we go up in this information, notice at the end of 2019, they now have $250 150,000 shares of outstanding stock. Whoa. It looks like in 2019, they issued 150,000 more shares of stock. We'll get to that later. Well, now with 250,000 shareholders at 22 cents a share, they paid out $55,000 in dividends in 2019. Substantially higher than 2018 for two reasons. They doubled their dividend rate and they have more shareholders because they issued more stock. This is a good thing for the shareholders, but it also could be a financial drain on the company as far as cash flow is concerned to meeting these dividend requirements by these shareholders. More about that later. Remember the three principles that we talked about last week of finance. The investment principle, invest in assets that produce returns. And the second principle, the financing principle. How and where are you going to raise the money for those assets? And then finally, the dividend decision principle. What are you going to do with distributing the income to the investors? Dividends. And you can see those three areas in these financial statements. So the income statement tells us a lot. Operating efficiency, profits. How much we're paying on debt service, interest. How much we're paying or getting a refund from Uncle Sam or Gavin Newsom, be whatever that is. And how much we're distributing in dividends to our shareholders. And if I was a potential investor, I would say, oh, 22 cents a share, that's pretty good. Let's hope they maintain that. I might buy some stock in your company. The balance sheet is a different story, where the income statement is for 12 months of these 2 years. The balance sheet is as of December 31st, 2018. December 31st, 2019. What did we own and where did that money come from? Well, let's talk about ownership. Cash, money in our bank accounts. Short-term investments. Well, if we have a little money, let's invest it. Maybe in a mutual fund, maybe in a money market fund, earn a little bit of interest over and above with it while it's sitting in the checking account. Accounts receivable. Services that we have provided and issued an invoice. They owe us the money. For most businesses, it's 30 days. $878,000 of money is tied up in receivables for this company in 2019. Ouch. I hope they collect those quickly. That's a lot of money tied up. And then inventories. How much product have we purchased or produced that's sitting on our warehouse or in our shelves waiting to be purchased? In other words, we've spent the money, we haven't sold them yet. Inventory. And many of you work for companies that have inventory and produce products. And what is one of the big sticky wickets of that? Make sure we just have enough inventory in stock to meet the demands of our customers. And let's not get inventory too high because inventory ties up cash. We spent to get it and now we're not collecting it by selling it. Inventory is a biggie. So as you can see, $1.7 million of inventory as of December 31st, 2019. That's a lot of money tied up. And that's current assets. Cash, investment, short-term, receivable, inventory, $2.7 million of current assets. a delta of $733,000 since the prior year. Our current assets increased by $733,000. And most of that was in an increase in receivables and inventory. That's cash that we don't have. We'll see that in the cash flow statement. That's negative cash flow. Not good. Then we get to our long-term assets. In this financial statement, they're called fixed assets. In some financial statements, they're called property, plant, and equipment. In some financial statements, they're called long-term assets, whatever. It's the investment in assets that produce return. Equipment, land, buildings, computers. And notice it didn't go up much this year. We only spent an additional $17,000 on our fixed assets. That means we don't have any more additional assets that can generate additional revenue. Not good. And then finally, accumulated depreciation. We depreciated $120,000 more off these assets due to our depreciation schedules during the year. And how that's important, because we see that number also down here on the income statement. Depreciation expense and a lowering of our asset position by what we've depreciated and accumulated in that depreciation for the asset's life. Current and fixed assets. Notice I took the deltas of these, how they've changed in the prior year. Remember that in a few minutes after our break. Let's look at our liabilities and equity. Short-term liabilities. Accounts payable, notes payable, and accruals. Two of these are called operating liabilities. Accounts payable and accruals. Many people call them working capital. Just like cash, short-term investments, accounts receivable, and inventories are working capital, short-term assets. Accounts payable and accruals are working capital, short-term debt. Non-interest bearing debt, which is important. You just have to pay it back within 30 days. Then why is notes payable here? Because notes payable implies that this is an interest-bearing debt. We have to pay interest because it's a note, probably to a bank. Well, why is it in current liabilities? Because this $300,000 is due in the next year. Part of our interest expense down here is this notes payable. So in in liabilities, accounts payable and accruals are short-term operating liabilities. Notes payable is short-term interest-bearing liability. And then we have long-term debt, debt that's due within over a year. Again, interest-bearing. It's called bonds, and we'll talk more about those next week. Bonds are a debt obligation to bondholders who lent us the money in the market, and in return, we give them interest or coupon payments. $500,000. Oh, I just did a quick number in my head and I never even noticed it. Notice our interest-bearing notes payable is $300,000. Notice our interest-bearing long-term bonds is $500,000. That's a total interest-bearing debt of $800,000. Hey, I bet you our interest rate is 10%. 10% of $800,000 is $80,000. That might be true, might not be. Well, it doesn't make any much difference. But a couple of things here. Notice the deltas or the change in these numbers for the last year. Accounts payable went up. Notes payable went down. We paid off some of it. Long-term bonds. Oops. Went down. Golly. I spilled a soda on my keyboard a couple of days ago, and the keys are very sticky. But say, look at that. What a class act. Let's do this one more time. There we go. Nope. Son of a gun. Let's do it the old way. Put in the formula. There we go. 500,000. So it looks like we paid off some debt in this company this year. Let's look at liabilities. Common stock. Woo. Looks like we sold and issued more stock this year. And we know that up here. We sold and issued 150,000 more shares of stock. That's a pretty good difference. Let's try it again. There we go. $1.2 million of cash coming into this company by the issuance of additional equity in the market. $1.2 million. That's the book value of the stock that was issued. So equity position increased this year because we issued more stock. Now I know where they got the money to pay off this debt from the stock issuance. We'll talk about that later. And then finally, notice our retained earnings. You probably forgot all about it, but when you are an accountant and you close the books of a corporation, you close out all the revenue and expense accounts and dividend accounts to retained earnings every year. And notice, if I take my net income, 253,584, and minus or subtract out my dividends paid, 55,000 for 2019, I get the delta of retained earnings, 198,584. Retained earnings went up from 2018 to 2019 by net income less dividends. And now we have accumulated $198,000 of profits for the company. So the balance sheet tells us how we fund these changes in our assets from debt and equity. When we come back from our break, we're going to say, okay, Mr. Hassey, I got this. The balance sheet, income statement, that's a no-brainer. Okay, I see what you're doing. But why are you doing all this here? Why are you doing all these deltas? What's up with that? I never see these in a financial statement. Why? Because all these deltas are in the cash flow statement right here. This what makes up the cash flow statement. The deltas in all these accounts of the financial statements. Just like that video told us a few minutes ago, the cash flow statement is a combination of the balance sheet and the income statement to show the changes, the sources, the uses of cash for this company. And this is the important thing for us in this class. This tells us what happened. Are we efficient? Are we operating efficiently? This company is not. Even though they're making a profit, they're breaking the cardinal rule of finance. The most expensive money you can get is issuing stock. Very expensive. Why? You have to hire an investment banker to go out and get it for you. 2, the stockholders are going to demand growth, stock price growth, dividend growth. Expensive. And this company took the most expensive form of capital, and what did they do with it? They paid off old debt. Money that they already had spent. That money should have gone to purchasing more assets to accumulate and grow the business and get that return that's needed by those shareholders. Now, all they've done is lower their debt position, but now they have less, their assets are not growing to meet those demands for the return growth of the shareholders. That's potential problems. So when we come back from our hour break, after our break, we're going to take a look at what makes up this cash flow statement for 2019 and what it tells us about the management of this company. I call the cash flow statement looking under the hood of a company. How is it really operating efficiently and financially solvent? We'll see that in just a minute, because you as a capital manager have to know how your company is doing. Are we a disaster or are we cool? You as a potential investor have to understand, why would I be giving my money to this company? They're not creating any growth. They're just paying off existing debt. You should use profits to pay back debt. And new capital goes into producing assets to produce more profits. They ain't doing it here. So we'll talk about that and look at that after our break. So I'll see you guys back here at 7:20, 11 minutes. 7:20, and then we'll go for another hour or so. 7:20, I'll see you all back here, and we'll pick up the cash flow statement. Okay, see you then.
Okay.
Preston.
Okay, we're back. The balance sheet and the income statement are the two main income statements that companies produce for their investors, for their internal managers. It tells us a lot. But for finance people, the cash flow statement is made up of the changes in these accounts and how they all end up totaling and netting out to the delta of cash for the year. Because cash is what companies live on. Yes, it's great to make $253,000 in net income. But if we are not generating any cash flow, we got a problem. Because if you're not generating enough cash flow, you're not paying your bills. If you're not paying your bills, you're going to get in trouble. So in order to pay your bills, you're going to have to borrow more money to pay those bills, instead of reinvesting back into the business in new technology and new assets to create growth. This is the struggle that many companies right now in the pandemic are going through. They're not generating enough cash flow to stay competitive in the markets. And the markets aren't there, they're drying up because nobody can buy anything. It's a tough situation. So notice, I have broken down the cash flow statement into three areas: operating cash flow, financing cash flow, and investing cash flow. And each one of these deltas in these accounts in our balance sheet and income statement end up in these areas of the company. Operating cash flow, net income, 253,584. That's from the income statement. Operating cash flow, positive depreciation, 120,000. Got that both from the income statement and the balance sheet. Wait a minute, Mr. Hasse, you're getting me all messed up here. Depreciation is cash flow? Yes, because really this company made in cash profits 253,584 plus the depreciation. They actually made more money in cash flow because of the depreciation, because they're not spending cash here. So that's why we add it back in to the cash flow. That's a good thing. That's why a lot of companies buy capital goods. They can be depreciated. They buy capital goods for two reasons. They create new products, more efficient products, growth, and they give you cash flow. And they give you a reduction in taxes. Because if I didn't have depreciation expense here, I'd be making more profit and I'd have to pay more tax. Okay. But then we got some problems. Operating assets and operating liabilities. Operating assets. Accounts receivable and inventory. In this case, they both went up, 245,000 and 429,000. Because those assets went up, that's negative cash flow here. Why? More people owe us money, we didn't collect it. We have more products for sale, we haven't sold them. Negative cash flow when inventory and receivables increase. That's why for a lot of small businesses, the management of and the operations of their receivable collections and their inventory management is crucial. So in this case, this company had an increase in receivables and inventory. That's negative operating cash flow. Accounts payable and accruals, operating liabilities. Now in this case, it's the direct opposite. When assets increase, that's negative cash flow. When liabilities increase, that's positive cash flow. Why? We're postponing paying the bill. So we're saving money. Now eventually, probably in 2020, these have to be paid. But as of December 31st, 2019, we haven't paid them, so it's positive cash flow. Net income, cash coming in. Depreciation, cash coming in. Negative increase in a receivables in inventory, cash going out. Increases in accounts payable and accruals, cash coming in. The net effect of all those, negative $170,536. Receivable, inventory, accounts payable, and accruals are called working capital. This company lost $170,536 in cash flow on operating their business. That's a no-no, not good. Financing, the next section. Where did we get the money to pay these assets? Well, if you notice, notes payable is interest-bearing financing, and so is bonds. Notice they're not up here in operations because these basically we're writing loans to ourselves. We have to pay the invoices. Here we have to go outside to a bank, to the bond market to acquire these funds, and in return we have to pay the money back plus interest. Well, notice on the balance sheet, both these areas of financing went down. Notes payable and bonds payable. Well, if they went down, that means we paid off some of that debt. So here it is. Negative cash flow, money going out of the business because we lowered notes payable and bonds. We paid them off, cash going out. Well, how did we supplement all this? We increased common stock. We issued 150,000 more shares of stock and received $1,220,000 in cash by issuing that stock. That's money coming in right here, common stock. We issued stock, cash coming in. We paid off interest-bearing long-term debt, cash going out. And again, as I said earlier tonight, I'm not going to ask you to put together these financial statements, especially cash flow. But you need to know what it tells you. That's important. And then finally, what's the last form of financing? Paying dividends. Paying dividends out to our shareholders. That's rewarding our shareholders who financed part of this company. And remember, we paid out 22 cents a share in dividends on 250,000 shares of stock, and that's $55,000 of dividends being paid out. So that's cash going out for dividends. So for the financing section of cash flow, money going out, paying off of debt and dividends, money coming in, the issuance of additional stock. Net positive $245,936. And then what did we do with money going out of the business? Investing. Well, we have two areas in this company of investments. Short-term investments right here, buying additional investments short-term to earn some extra money, and the investment in assets right here. The purchase of additional equipment, fixed asset, land, buildings, computers, whatever, $17,050. So in our cash flow statement, short-term investments increased, money going out. Fixed assets increased, money going out. The net effect of that is $68,682 of money going out. So, operating cash flow, negative. Financing cash flow, positive. Investing cash flow, negative. The combination, $6,718. And golly, there it is right there. Cash changed by $6,718. So the net effect of all the activity in all these accounts and statements is $6,718. And that's where the cash went. So this company has a problem. They made $253,584 in profits, net income, but their cash only increased by $6,718. And that's including raising capital by selling an additional amount of 150,000 shares of stock. What did they do with all that money? They paid off old debt, and they are not collecting their receivables and inventory. That's why their cash position only changed by $6,700. They have a collection problem and an inventory problem. Now, this might be only short term. Maybe this all turned around in 2020. We'll have to take a look at the financial statements for 2020 to see that. But at the end of December 2019, it didn't look very rosy. So in summary, this financial statement, you need to be aware of what this stuff is. You don't have to put it together. But what do I mean by the balance sheet, the income statement, and the cash flow statement? That's for you to study and to understand. And then we go to our next area, called financial analysis, reviewing corporate performance. And with that, we go to our textbook, page 105 of our textbook, Interpreting Financial Ratios. Now, you don't have to know all of these, but you got to know some of them. And in chapter 4, they give you the formulas to calculate these. Plus, within the text of the chapter 4, they define each one of these. And either write this down or you'll have this recorded, but these are the ones you're going to need to know for future assessment. I mean, work and grading. Notice they're broken into groups. This is taken right out of the page 105 of our textbook. Performance measurements, profitability measurements, efficiency measurements, leverage measurements, liquidity measurements. These are taking the balance sheet, the income statement, and the cash flow statement and telling us something about the company. The first one you need to be aware of is return on assets. Circle that one. Income, net income divided by total assets. Operating return on assets. Next one. Average collection period in days under efficiency measures. Average collection period. How long does it take us to collect our money? Next one. Inventory turnover. How fast do we turn over our inventory? In other words, we purchase it or buy it, we sell it, we do it again, we sell it. How many times during a year do we do that? Next, all under efficiency, profit margin. Net income divided by sales. We need to know that. Next one, under leverage, debt ratio. Total liabilities divided by total assets, the debt ratio. And finally, the last one that you need to know. All the rest of them I'm never going to ask you about. Current ratio. The relationship of current assets to current liabilities. In review, you need to know return on assets, receivables turnover, average collection period, inventory turnover, and profit margin, debt ratio, and current ratio. You will be asked questions about these in future work. Not only in assignment 1, but in assignment 2, and so forth. Their definitions are in the chapter 4. You need to be familiar with those. So let's try to find these for the company that we're working on tonight. Let's try to locate and calculate this information for our company tonight. Let's find these things and what do they tell us about our company. The current ratio, the relationship of current assets to current liabilities. So we go to the balance sheet. For 2018, current assets, $1,946,802. Equals $1,946,802. And that is divided by the current liabilities, $1,328,960. 1.46. That's the relationship of current assets to current liabilities in 2018. What is it in 2019? This is why I love spreadsheets. You just slide it over. Whoa, 2.58. The industry average for this company in their industry with competitors is 1.25. Now, we already know why their current ratio is so high in 2019. Remember? Receivables and inventory. Ugly. That's their current ratio. Current assets divided by current liabilities. We need to know how to calculate that from the financial statements and what it means. It means liquidity, working capital liquidity. Debt ratio. Total debt divided by total assets. So equals total debt, right there, divided by total assets for 2018, 80.68%. Whoa. The average for most companies about 60 to 65%, especially in these days. For 2019, you slide it on over. Whoa, 43.78%. Why? Well, we know that reason too. Why did it go down? We paid off $920,000 of debt. That's why it went down. We paid off all that debt with the issuance of that stock. The industry average for this company is 60%. So they were highly leveraged in 2018. So they issued stock to get rid of that, reduce their interest expenses. But they issued very expensive capital to pay that off, the issuance of equity, stock. Very expensive. Profit margin. The relationship of net income to sales. So this is income statement. So we go to the income statement. So in 2018, net income is a loss. So equals net income divided by revenues, sales. Negative 1.63% because we lost money. The profit margin for 2019, we just slide it over. 3.6%. In other words, at least they're making money. In other words, for every dollar of sales, they're making 3.6 cents. The industry average, $5.25. Oops, should be a $5.25. Oops, that's right. That should be a percent. What am I doing? There we go. There we go. Oh, make it over there, guys. Here we go. There we go. Okay. That's the industry average. So the profit margin is the percent of net income to sales. You know what the profit margin for Amazon was in 2019? 32%. 32%. Ouch. I mean, great. Return on assets, net income divided by the assets of the company. What are my assets returning in profit? So equals net income divided by the total assets of the company. Naturally, it's negative because we lost money. Slide it over for 2019, 7.21%. Not bad. Our assets are returning 7.21% of our money. For every dollar invested in assets, it's returning a profit of a little bit over 7 cents. Industry average, oops, not 6, it's 9. 9% is the industry average. Now, where do you get these industry averages? Next week, I'll show you where you get them. We can get them right from our resources as being a Laverne student through the library. And I'll show you that next week. Here's another one. that's not on page 105, but I need you to know about it. It's called the price earnings ratio. The relationship of the stock price in the market to the earnings per share of the company. Well, what is the earnings per share? The earnings per share is the net income of the company divided by the number of shares of stock outstanding. So in 2018, they had an earnings per share of negative 95 cents a share. For every share of stock outstanding, they were losing 95 cents. For 2019, a little better, $1.01. Now, what does that mean? Well, if any of you, because of the nature of this class, are starting to watch and follow the business news, in the next 2 weeks, many companies will be announcing their financial results for the quarter ended September 30th. And most of those financial results will say our earnings per share last quarter were $1.01. They won't say they made $10 million or $253,584. They won't say that. They say we made earnings per share of $1.01. That compares to a 95-cent loss in 2018. That's how many companies announce their returns or their financials, by earnings per share, breaking down their profits by the number of stockholders they have. So what is the price earnings ratio? It's the relationship of the stock price at the end of the year. In this case, in 2018, it was $6, divided by the earnings per share. Oops. Yeah. Oops. I just made a mistake. Let's try that again. Equals the stock price at the end of the year. For 2018, it was $6 being traded in the market, and that is divided by the earnings per share, negative 6.31, and I'll explain that in just a minute. Let's do it for 2019. 12 was the PE ratio. The market return or average was 10. What does this mean? It means the relationship in a ratio between the stock price and how much that stock is earning in profits per share. Now for 2018, it was negative because they had a loss, so that doesn't do us much good. But in 2019, the relationship of the market to the earnings was 12 times greater. The stock price was 12 times greater than the earnings per share. Now in the market, if I was an investor, and we'll talk about this next week, if I was an investor, I want to invest in a stock that has a low PE ratio. The relationship of the stock price to the earnings is low. In other words, the stock is undervalued. It has room to grow. So why not I should buy it? It's cheap. But if the price earnings ratio is like 40 or 50, I might want to stay away from it because it's pretty overvalued in the market. There's not much room for it to grow in relationship to the earnings that that stock is producing. Now we'll talk more about this when we get into stocks next week. But that's an indicator for performance. If you call up your broker, if Jasmine calls up her broker tomorrow morning, hey, Mr. Broker, I want to buy a stock that has a PE ratio of 10 or lower. And her broker would go, 10 or lower, Jasmine? And she said, yeah, it's undervalued in the market. You know what her broker would do? Damn, you have Professor Hasse in finance. You know exactly what's going on in the market. You're buying undervalued stock thinking it's going to go up in price by looking at the price earnings ratio. Or tomorrow, Leonard might call up his broker and say, hey, dude, sell my stock in Tesla. Why do you want to do that? because the PE ratio is 65. That sucker is way overvalued. I'm going to get out now before it starts dropping even more. Sell it. Damn, another Professor Hasse student. This guy knows more about the market than I do. Well, we're going to study this next week. But that's exactly why Warren Buffett became a very wealthy man. He bought undervalued stock. He bought Geico when nobody ever heard of Geico. He bought See's Candy when nobody ever heard of See's Candy. He bought Lazy Boy chairs when nobody ever heard of Lazy Boy chairs. He bought Wells Fargo. Now he's since sold it, but he bought Wells Fargo years ago when Wells Fargo was just a regional bank. He bought Coca-Cola in the 1950s when only people who knew about Coca-Cola were in the southern part of the United States. He bought these companies when nobody knew about them because they were undervalued. And then when they started catching on, Coca-Cola. Have you ever gone through a Christmas without munching on a See's Candy? And look at television. There's a friggin' Geico commercial on every hour of the day. Warren Buffett owns all those companies. Whew. That's why he's wealthy. Because he has traders and financial analysts looking for undervalued investments. And the PE ratio is one of those indicators. Tells us a lot about the relationship of the profits being generated by a company to the market interpretation or value that the market thinks it's worth. Okay. Whew. Earnings per share, PE ratio.
Hi, Professor.
Yes.
When you said something about 40, because the industry is 10, the market value. You mentioned something about 40. If it's 40, it's a good indicator.
Well, it's a bad indicator. It means the company is overvalued.
Okay.
The higher the PE means the relationship of the net income to the market value is quite large. That means the market thinks this company is doing a lot better than they really are. Why is that? You guys know this. Tesla's been overvalued for years. Now look at the price. The market's figuring that out. Plus the pandemic.
Professor Hasse?
Hasse, yes.
Yes, Hasse. What is the perfect PE to look for then?
Well, it depends on the industry. All right. Certain industries like technology have different PE relationships than like manufacturing or retail. Okay. This is why you take Professor Hasse's MBA finance investment class to learn how to do this. But you got to be in the MBA program.
Thank
So
you.
don't worry about that. But every industry has their own relationship. But I'll give you a general rule of thumb. The general rule of thumb is if the PE is greater than 20, it's overvalued. If the PE is under 20, it could be a buy, it's undervalued. Undervalue, under 20, overvalued, over 20. That's very general, but that's a good rule to go by. Again, when we're going to do the PE ratios, we're going to look those up for our portfolios later on. For the portfolios you guys are selecting, we're going to do some of this analysis with our holdings and see what that tells us about our stock. We'll be practicing this in other assignments down the line. Did I answer your question?
Yes,
I think so.
thank you.
Okay. All right, here's two others. Average collection period. How long does it take us to collect our receivables? All right. And here's another one. Inventory turnover. How often do we turn over our inventory? Now remember, in this company, accounts receivable inventory were kind of ugly numbers. There were a lot of money tied up there. So let's take a look at this. I want to go back, first of all, let's go back to page 105. Remember, Average collection period is receivables at the start of the year. Your accounts receivable balance at the beginning of the year divided by daily sales. Okay, remember that. Receivables at the start of the year divided by daily sales. Okay, inventory turnover. Cost of goods sold from the income statement divided by the inventory at the start of the year. So let's write those down and remember them. And let's take that information and calculate these for this company. All right. So first of all, let's do average collection period. What's our inventory at the beginning of 2019? Well, it's our inventory at the end of 2018. 1,287,360. That's our beginning 2019 inventory. Oops, sorry, right there, 632,160. That's our beginning inventory balance of 2019, 632,160. So let's go back to this. Equals.
Professor,
Yes.
it's still page 105. We can't see what you're doing.
Oh, sorry. Thank you. Thanks, Jake. Sometimes I get a little fast and loose with my moving around here. There we go. Thank you, Jake. So here we go. So we go back to this. So our inventory was 632,160. And we're going to divide that by average daily sales. Now, what is that? Average daily sales is the total revenues of the company for the year in 2019. What were our total revenues? $7,035,600. That's our total revenues for the year. 7 million, oops. Let's get that out of there. So we put that in parentheses, 7,035,600 divided by how many days in a year? 365, right? Average daily sales is revenue divided by how many days in the year? So I'm taking revenue, dividing it by days in the year, and I'm dividing that number into my beginning receivable balance. And I get almost 33 days. It's taking me in, oops, that should be in 2019. That's all right, we'll leave it there. So in 2019, my average collection period is 32 days. A little bit over average. We should make it probably 30 days, but it's 33 days, which isn't that bad. What's our inventory turnover in 2019? It's our cost of goods sold from the balance, from the income statement, cost of goods sold, 5,000,008, divided by beginning inventory balance at the beginning of the year, 1,002,360. So let's do that. Inventory turnover, cost of goods sold, divided by beginning inventory balance. Our inventory turnover is 4.5 times. In other words, we buy our inventory, we sell it. We buy our inventory, we sell it. We buy our inventory, we sell it, and so on. Almost 4.5 times. The industry average is 11. Our competitors are selling their inventory 11 times a year. We're selling it 4.5 times. We got a problem. I forgot to give you this. Our industry average for collections in this industry is 28 days. We're not too bad. Still, we're a little bit higher than our industry average. We're not collecting it fast enough, and we're not selling it enough. It's staying in inventory. Now, why do products stay in inventory? A variety of reasons. The retail price is too high. In order to move them, we got to discount them. The product is deemed as inefficient compared to competitors' products. Okay? Could be a variety of reasons, but that's a problem for this company. We got to sell our inventory more. Or we got to reduce our inventory to make it more equal to what our consumers are demanding of our product. Okay, These are what is called financial statement analysis. I'm going to save this and post it back to Blackboard in that week 2 in-class review. You need to know these. 1, 2, 3, 4, 5, 6, 7, 8. You need to know these. I'm going to test you on this next week in assignment 1. Assignment 2, you're going to be looking up some of this information for your stocks in your portfolio. Ooh. We're going to be looking at these a lot because they tell us about trends in our business, in our industry. Very important. We'll be using these a lot more than we'll be using any of this. But it's still important to know this. But we'll be doing a lot of this.
P&E, is that addressed in chapter 4 also? I know.
No, I'm telling you that. That's my Mr. Hassey hint of the night.
All right. And you're going to post this video on so I can re-go over and write all the equation down?
Right on, Jake.
All right.
But I bet you if you go to your textbook and go to the index and look up PE ratio, I bet you it's in there someplace. Probably not in chapter 4 though.
Roger.
I bet it's in there. But don't worry about it. You got it. You got covered here.
Roger.
Here's a template of how to calculate it. You have the video.
Roger.
Okay. So there's that. Now, if you want to practice some of this, you don't have to. But if you want to practice, you can go to your Blackboard. And go to your week 2 file folder and go to the very bottom. And here's some problems taken out of the end of the chapters with their solutions that you can test yourself. Problem 7 in chapter 4 here, 112, is doing exactly what we just did for another company, looking at their financials. If you want to practice those, go right ahead. I've provided the solutions to them. You don't have to do them though. It's just practice. What is this doing here? Okay. Okay, so that you have some problems if you want to practice, and I provided the answers to that. The same thing holds true with chapter 3. But you can pretty well go to the bank and look at your spreadsheet, and that'll give you sufficient enough of information that you need to know for your work ahead of you and to study. Just what we just did here. You don't need to do too much more than that. But just in case any of you would like to do that. Okay, so now where are we at 8:01 on a Tuesday, on Monday night, October 5th? We now know the definition of finance. We now know what we mean by financial markets. We now know and have been refreshed with the idea of financial statements. And we now have an understanding of what financial statement analysis is. Chapters 1 through 4. And this material that we just studied is telling us where we are today. Where we're going to in the future begins next week. Begins in our studies of the next chapters. That's where we're going to. And that's financial strategy, financial management. Where we are today is what we looked at tonight. And your financial portfolio that you're creating this week is a link between where are we and where we are going. Because the financial markets take a look at financial performance from financial statements, and they value your company in the market. Your performance as managers values your company in the market. Why do you think Amazon is $3,500 a share or whatever it is these days? Because the market thinks that they are just kicking butt. But Radio Shack is 25 cents a share. Ouch. Why? Nobody wants it because they're not doing anything. They're done. It's called basically a penny stock now. So where we are determines where we go next, because Amazon wants more. They want more assets, more markets, more efficiency, more technology. Where we are today will drive our decisions in looking at future chapters and future study in this class. Where do we invest in new assets? How do we measure that? Capital budgeting. How do we finance it, and what is it going to cost us? The cost of capital. But that's for later editions. Tonight, you just need to be concerned about what's the definition of finance? What are the financial markets? What are the key financial statements, and what information they provide us? And how do we interpret financial statements with key ratios or analysis that tells us about certain things about a company? That tells us about a company's liquidity, their debt management, their profitability, their market value and profitability in the market, and their efficiency. Are they managing their business well? So we take a look at the financial statements to answer these questions about our companies. You're going to be doing it for your stocks in your portfolio. And down the road, you're going to be doing it where I give you a balance sheet of a company, and you're going to tell me, guys, what happened? What does this tell you in your interpretation of how this company is operating? Would you invest in this company? Would you go to work for this company? Would you just stay away from this company? I tell a lot of my seniors in business administration, when they start going out on internships and job interviews, the first thing you should do, because you've been trained already in the program, is when you go into a job interview, you should have in your mind a good idea of what the financial statements of this company you're interviewing for are. What's the current earnings per share of the organization that you're interviewing with? What's their debt ratio? Boy, if you can whip that on them in a job interview, they're going to say, ooh, this guy did his homework. He must have had HASI in finance. He's ready. These are important things. But be that as it may, forget about jobs and internships and future jobs. Think of you as an investor in your 401k plan. When you get your financial pension plan or your 401k statement in January every year, and it tells you you made 3% when the market made 25%. Why am I not invested in certain companies? You can take a look at that and understand, hey, what's going on here? Maybe I shouldn't be in this 401k. I should be somebody else managing it. So as a personal finance, this stuff will help you as an investor. So this will lead into further questions and other analysis down the road. So where do we go from here? Well, many of you still have to complete your work for your portfolio. Many of you have to make an appointment with me this week so I can say hi and bend your ear a little bit tomorrow, Wednesday, or Thursday. That's the first thing you need to do. Next week, you need to read Chapter 5. And I'm going to talk a little bit about Chapter 5 right now. And then we'll call it a night. Because next week, you have your first assignment posted. And here's how that works. Next week, during our class time, next Wednesday, October 14th, your assignment number 1 will be posted to Blackboard. When you're done with class, you will download that assignment, do the work in a file, and then post it back to that file folder by Sunday, October 18th. I will grade it, send it back to you. Everybody gets an A. We're smiling. Then also next week, see, we're doing that off-site. You're doing that at home during the after class on Wednesday, due Sunday. But next week, we're going to talk about Chapter 5. And what Chapter 5 is the link between where we are right now and where we're going into the future. It's called the time value of money. Melissa Stevens, your birthday is October 14th? I don't care. I really don't care. I'm teasing you. So Melissa, Michael, Jake, remember this, write it down. Melissa's birthday is next Wednesday. That means when you guys go to assignment number 1 and do the work next week, Melissa's going to have a special assignment just made for her, about 50 times harder than the one everybody else will be using. And Melissa, you'll be celebrating your birthday by doing assignment 1. Thank you. Where's Melissa? I don't even see her. There she is. Oh, she's with Melissa. I forgot the name of your child's name. What's your name?
Preston.
Very nice. Preston has red hair, correct?
Yeah.
Stop picking on the Libras, Professor.
What's that?
Stop picking on the Libras. My birthday was Friday.
Sorry to hear that. Who said that?
Jacob Porter.
Jake, you're a Libra.
Yes, sir.
What does that mean? What type of person are you?
I'm always the one trying to find the just way of things.
Oh, well, that's nothing wrong with that. You're having a tough time these days, I bet.
Eh.
Okay, I'm a Leo. I drink a lot. No, that's a joke. Okay,
You must be Irish also.
I got a little bit of that in me. Okay, so let's talk about Chapter 5 here. So we go back. We got about 10 minutes left, guys, so it's okay. The Yankees are still winning. I don't know who won the football game, so we'll see about that. Okay, we're back to this. What is the time value of money? And remember, I just said a key thing. It's a link between today, the present, if I can spell it right, and the future. And a lot of us run into this every day and we don't even know it. Well, you probably know it. It's called inflation, right? Inflation is time value of money. Inflation. Right now, the inflation rate in Southern California is approximately about 2.25%. It's been fluctuating between 2 and 3.5 for the last year. In other words, a year ago, prices were 2% lower than they are now. Inflation. That's cost of money. So you want to, hopefully you were invested in money last year that made more than 2.25% or 2.5%. You were invested in the stock market that made 12%. You were invested in a money market fund that made 5%, whatever. So that means you are worth more today because you beat inflation. But a lot of us aren't. A lot of us don't have that kind of money to invest in the stock market, and inflation eats up at our pay, especially now when we work for these cheap son of a gun employers who just say, oh, you just should be thankful you have a job. Here's a 0.5% increase in your pay this year. Here's a 1% increase. You should just be thankful you have a job. I'm giving you 1%. Hey, dude, inflation rate is 2.5%. I'm worse off now than I was last year. You're working. Take it easy. Well, it's the same thing holds true with managing and investing in companies. What is our cost of money, inflation, compared to what we're earning off that money? We begin to study that in Chapter 5. It's called the present value of money. And the future value of money. In other words, what is the value of money in the future? What is its present value today? And the vice versa. What is the present value of money today valued in the future? And it's all driven by three things: principal, rate, and time. Principal is the amount of money involved. Rate is the interest rate. The interest rate currently in the market. Remember last week when I showed you that entry PowerPoint of key indicators in the market? And remember that one, the 10-year United States Treasury yield? That's a key present value and future value interest rate in the market. We'll talk about that next week. Principal, dollars, rate, interest, time over how many periods? What is it? 29 years ago, my son was born. 29 years ago. What an old bastard he is now. 29 years ago, my son was born. When he was born, his mother and I said, okay, we're going to sock money aside. We're going to put some money into a bank, and we're going to invest it over 18 years. And when he's a senior in high school, that money, whatever it is, he'll use to go to college. He won't use it to buy a BMW. He won't use it to get married. The only thing he'll use it for is to go to college. If he doesn't want to go to college, his mother and I will go on a vacation. And that's exactly what we did. When he was born, we took that money and invested it for 18 years. Well, what investment did we buy? We bought a United States Treasury, an 18-year Treasury, and we bought $20,000. And that was invested at a rate of 6.5% a year over 18 years. The future value of that investment is what he got when he turned 18. $20,000 was the present value. It was invested at 6.5% annually for 18 years. Well, if I go to my little handy dandy computer spreadsheet, which I had back then, I didn't have a spreadsheet, I didn't have the luxury, but if I went to my spreadsheet, I'll make this big for you. We'll learn this calculation next week, but I'm showing you now what it looks like. If I would go into formulas, function, financial, future value, I'm investing something at 6.5%. That's the rate over 18 years. And I'm investing, the present value is $20,000. How much did I have in 18 years for my son to go to college? $62,133.09. And that's exactly what I got. Now, the big thing is I had to come up with the 20 G's when he was born. So I had to sell some of my retirement. But when he got to be 18, he had a nice chunk of change to go to college. Now, $62,000 when he went to college paid for maybe 1 year at Harvard. He didn't go to Harvard. $62,000 back when he was in high school could have paid for 4 years at Laverne. He didn't go to Laverne. But $62,000 paid for about 2.5 years at Boston College. And that's where he went. So that gave him a pretty good start to go to college. But I invested $20,000. I did the same thing for his little sister a couple years later. I invested $20,000 in an instrument called a United States Treasury over 18 years at 6.5%. And when he turned 18 and he picked Boston College, we gave him a check and he used that to pay for his college, part of his college. Pretty good. But that's an example of future value. And that's what Chapter 5 is about, how to understand that, how to calculate it, and how to determine it. Because we're going to be doing a lot of calculations in the future of where we go next to determine that future value. And even the present value too. So that's something that we need to be familiar with and learn how to calculate that using a spreadsheet. And we'll practice that next week. So I'm going to save this, post it to our Blackboard. I'm going to save this file folder or the spreadsheet and post it to Blackboard when we're done. And does anybody have any questions? This recording will be posted tomorrow morning. Thank you for your attention. The only graded work you have this week is to make an appointment with me and shoot the breeze for about 10 minutes. If you don't do that this week, you'll get a 0. If you do that, you'll get 100. Guaranteed. You can even call me a total jerk and I'll still give you 100. That's okay. All right. So I'll see you guys all either tomorrow, Wednesday, or Thursday. And if some of you can't make those times, I'll see you next weekend and we'll arrange a time. So thanks, everybody. We'll see you later this week and I'll see you next Monday evening.
Thank you.
Adios. Adios. Bye-bye.
Thank you.
Thanks. Bye.
Night, everybody. Be safe. Thanks, Lawrence. Be safe.
Thank you, Professor. See you tomorrow.
Thank you, Doreen. Thank you.